Stop using conventional loans to scale your rental acquisitions. Your portfolio could grow twice as fast in 2026 with just one simple financing shift. DSCR loans are becoming the express lane for investors in 2026. This isn't just another mortgage product, it's the strategy top investors are using to expand fast. If you want to grow your rental portfolio without the usual lender headaches, DSCR loans are the most important tool you'll learn this year. As a quick reminder, this video has a written presentation to follow along. Don't forget to download a copy from my training website so you can print it, follow along, study it, and make notes. The link to the training website to download this presentation is on the screen and in the video description. And if you enjoyed this training, be sure to subscribe, like, and comment. At its core, a DSCR loan is an innovative non-QM mortgage specifically designed for investment properties. What makes it revolutionary is how it qualifies you. Instead of scrutinizing your personal income, employment history, or tax returns, lenders focus solely on the property's ability to generate sufficient rental income to cover its expenses. We use a simple formula: rental income divided by PITIA, that's principal, interest, taxes, insurance, and any HOA fees. A DSCR of 1.0 means the income generated covers all expenses, while 1.25 or higher signals robust cash flow, meaning that the income supersedes the expenses, unlocking the best rates. As you can see, it's all about the property's performance. Understanding what lenders prioritize with DSCR loans is key to leveraging them effectively. They'll closely evaluate the market rent of the property, the actual lease income if it's already occupied, your credit score, the loan-to-value ratio, and the property's specific expenses. Critically, what they ignore sets these loans apart. No W-2s, no tax returns, no pay stubs, and no deep dive into your employment history. This makes DSCR loans absolutely ideal for investors with complex financial profiles, those who are self-employed, or individuals who utilize significant write-offs. It streamlines the entire qualification process. Let's talk practical requirements for DSCR loans as we move into 2026 and 2027. Typically, you'll need a credit score of 620 to 680 to qualify, with the best pricing becoming available at 700 and above. Down payments are generally in the 20 to 25% range. Loan amounts are flexible, spanning from $75,000 up to $6 million, accommodating a wide spectrum of investment properties. These loans cover single-family rentals, 2 to 4 unit properties, condos, and townhomes, and are perfectly suitable for short-term rentals. Ownership can be either through an LLC or in your personal name, offering excellent structural flexibility. The best part? Closings can happen in as little as 14 to 21 days. Grasping the nuances of your debt service coverage ratio is vital for securing the most favorable loan terms. Your DSCR is a direct indicator of your property's financial health and its capacity to service its debt. A DSCR between 0.75 and 0.99 means the property doesn't quite cover its payments, but some lenders may still consider it with pricing adjustments. A ratio of 1.0 to 1.24 indicates the property covers its expenses at or above a break-even point, making it widely acceptable. However, targeting a DSCR of 1.25 or higher is your optimal strategy. This signifies strong cash flow and will qualify you for the most competitive rates and terms, putting you in a preferred position with lenders. Looking ahead to 2026 and 2027, a well-qualified borrower with a strong credit score, favorable loan-to-value, and a DSCR of 1.0 or greater can anticipate rates for a 30-year fixed DSCR loan in the vicinity of 7%. It's important to frame these rates in context. DSCR rates typically run about 0.5% to 1.5% higher than conventional investor loans, which is the premium for sidestepping income documentation. However, they are significantly lower, often 3 to 5% less than hard money loans, making them a superior choice for long-term holds. Your individual rate will be influenced by factors like your credit score, LTV, the DSCR ratio itself, and the property type. When choosing your financing path, understanding the distinct advantages of DSCR loans over conventional options is paramount for growing investors. Conventional loans demand extensive personal income documentation, like W-2s and tax returns, and are generally restricted to individual ownership for investment properties. In contrast, DSCR loans qualify based purely on the property's rental income, require no personal income docs, and are fully amenable to LLC ownership, which is a massive benefit for strategic portfolio structuring. While conventional loans might offer slightly lower rates, the flexibility, speed, and corporate ownership options of DSCR loans provide an invaluable edge for scaling your investment strategy without being bogged down by personal financial scrutiny. Every powerful financial tool has its advantages and trade-offs. The pros of DSCR loans are compelling. No personal income documentation required, significantly faster approvals, unmatched potential for portfolio scaling, LLC-friendly terms, and compatibility with both short-term and long-term rental strategies. On the flip side, you can expect slightly higher interest rates compared to conventional loans, larger down payments, and potentially higher fees. These loans are strictly for investment properties, not owner-occupied homes, and you do bear the inherent risk of rental income fluctuations. However, for the serious investor, the benefits of flexibility and accelerated growth often far outweigh these considerations. DSCR loans truly shine for specific investor profiles. If you're a self-employed investor, navigating complex tax situations or write-offs, these loans bypass the traditional income verification hurdles. For short-term rental or Airbnb operators, where income can be less predictable, DSCR loans focus on the property's proven earning potential. LLC buyers benefit immensely, as these loans accommodate corporate ownership structures, simplifying legal and financial management. And crucially, for portfolio scalers, DSCR loans offer the efficiency and speed needed to acquire multiple properties without repeated personal income scrutinization, acting as a crucial accelerator for growth. Before we end, and as a final reminder, this video has a written presentation to follow along. Don't forget to download a copy from my training website so you can print it, follow along, study it, and make notes. The link to the training website is on the screen and in the video description. And if you enjoyed this training, be sure to subscribe, like, and share. In summary, DSCR loans are an indispensable financing solution for today's rental property investors, especially those aiming for high-value markets. Their primary advantage lies in qualifying based entirely on a property's cash flow, making them accessible even if your personal income profile doesn't fit conventional molds. Aim for a DSCR of 1.25 or higher for the best terms. The ability to use an LLC for ownership coupled with fast closing times provides unparalleled flexibility and efficiency. While rates might be slightly higher, this premium is a worthy investment for the speed, flexibility, and scalability these loans provide, ultimately empowering you to build a robust and expanding real estate portfolio.